Today we'll be looking at the effects of transactions on the balance sheet. First, what is a transaction? A transaction is a financial activity or event. Each transaction has at least two effects, and this idea is the foundation of what is usually called the double entry accounting system. Transactions can be divided into two categories: cash transaction and credit transaction. Cash transaction involves the immediate use of money. So this is like going to a store, purchasing an item, and payment is made immediately. This either affects cash in hand or cash at bank. On the other hand, credit transaction is when payment or receipt of money is delayed until a later date. So this is like going to the store, taking an item, but payment is not made immediately. So here in Jamaica, we would say going to the store and trusting an item. So this affects the amount owed to suppliers. We also refer to our suppliers as accounts payables or creditors, or the amount owed by customers. And we also refer to our customers as account receivables or debtors. Here we have 3 bulleted points to guide you in recording transaction using the statement of financial position, otherwise known as the balance sheet. So for each transaction, identify the two items that will be affected. So we can have various combination of assets, we can have assets and liabilities, and we can have assets and capital being affected in a transaction. For each item, you are to decide whether its value will increase or decrease when the transaction occurs. And then after which, you are to prepare a new balance sheet and check that the total still agrees. So now we're going to analyze this transaction. And it reads, Peter has just opened his business. His financial statement as at March 1, 2019 is as follows. So equipment, $22,000, vehicle, $15,000, cash at bank, $5,000, cash in hand, $1,000, capital, $35,000, and bank loan, which is repayable in 1 year, $8,000. So during the first week in March, the following transactions took place. So we are to complete the table to show how much the assets, liabilities, and owner's equity have been changed. So we're going to read the transaction. On March 2, Peter purchased some additional equipment and paid by check $3,000. So now we are to identify the two items being affected in this transaction. They are equipment and check. And whenever you see check in a transaction, it represents bank. So now we are to see whether these items will increase or decrease as a result of the transaction that would have taken place. So if Peter purchased some additional equipment, this means that equipment would be increasing in the business. So hence, equipment is an asset. So we need to come to the asset section of the table. We're going to place a small plus to show that equipment is increasing, and then by how much. So plus equipment, $3,000. Bank is also an asset, and bank is decreasing because money was taken from the business bank account to purchase these equipment. So we're going to place a small minus beside bank and then by how much. So minus bank, $3,000. So the liability section was not affected, so we're just going to place no effects. Capital, our owner's equity, was not affected, so we're going to place no effect as well. So on March 3, Peter repaid $1,000 of the bank loan by check. So again, we're going to identify the two items that are being affected in this transaction. And it is bank loan and bank, because check represents bank. So bank loan is a liability because it is what the business owes. So if Peter repaid $1,000 of the bank loan, this simply means that bank loan is going down. So Peter now owes less for bank loan. So we're going to go to the liability section of the table. We're going to place a small minus to show that bank loan is going down and by how much. So minus bank loan, $1,000. Bank is an asset, and if Peter repaid the bank loan using money from the bank, this simply means that the money in the business bank account would be going down as well. So bank is an asset. So we come to the asset section of the table and we write minus bank $1,000. So owner's equity was not affected in this transaction, so we're going to put no effect. So on March 4, Peter introduced additional capital of $6,000 in his business. This amount was paid into the bank account of the business. So the two items being affected in this transaction would be capital and bank. So capital right here represents owner's equity. So Peter introduced additional capital of $6,000. We're going to have plus capital $6,000. Bank is an asset, and if the owner invested money in the business bank account, this simply means that the bank would be increasing. So the money in the business bank account would be increasing. So we come back to the asset section of the table and we put a small plus to show that the money in the business bank account is increasing by $6,000. And then this transaction did not have any effect on liability. So we simply put no effect. Alright, so on to the final transaction. So on March 5, Peter purchased some additional equipment on credit. The amount due is $4,000. So the two items affected in this transaction would be equipment and creditor. So equipment is an asset. Equipment is an asset. So we come to the asset section of the table. And if Peter purchased some additional equipment, this simply means that more equipment is coming in the business. So we're going to have plus equipment $4,000. And the other item affected would be creditor. And how do we know that? Peter purchased some additional equipment on credit. So this affects the amount owed to creditor. So we need to go to the liability section of the table because creditor is a liability. So we need to go to the liability section of the table and we need to show that Peter now owes for these equipment. So we're going to have plus creditor $4,000. And this final transaction did not have any effect on owner's equity. So we simply put no effect. And now we would have completed all the transactions in the table. So the first transaction, it would have signifies that two assets or various combination of assets were being affected. The second transaction would have showed that an asset and a liability was being affected. And the third transaction would have revealed that an asset and owner's equity were being affected. So now we're going to go to the working out section whereas we're going to recalculate the balance sheet items that were affected by the transaction. So we have equipment, bank loan, capital, and creditor. So the first one we're going to start off with is equipment. So we need first balance sheet that was given and see if a figure was provided for equipment. And here we have it, $22,000. So this is what we're going to start off with. So we take that $22,000 and we bring it right here. So I'm going to put the original figures in red. And then now we're going to go to the effects table and we're going to highlight all the transaction where equipment was being affected. So in the first transaction right here, we see that equipment was increasing by $3,000. So we're going to add this $3,000 to the $22,000 that was there before. So when we add $3,000 to the $22,000, we get $25,000. Then we're going to head back to the effects table and check to see if equipment was being affected in any other transaction. So equipment was not affected in the second transaction. It was not affected in the third transaction, but indeed it is being affected in the fourth transaction. And here again, we see that equipment was increasing by $4,000. So we need to add this $4,000 to the new figure that we would have gotten. So $25,000 plus $4,000 gives us a new figure of $29,000. So this new figure we're going to bring it over to the new balance sheet for equipment. All right, so now that we're through with equipment, we're going to recalculate the figure for bank. So again, we go back to the old balance sheet and we pick up that original figure that was there for bank or cash at bank. It's the same thing. Here we have it, $5,000. So original figures in red. And then now we're going to go to the effects table. And we're going to identify all the transactions where bank was being affected. So in the first transaction, we realized that bank was decreasing by $3,000. So we're going to minus or subtract this $3,000 from the $5,000 that was originally there. So $3,000 from $5,000 leaves us with $2,000. I'm going to head back to the effects table. In the second transaction, bank was also affected, and again it is decreasing by $1,000. So we're going to subtract that $1,000 from the $2,000 that was remaining. And this leaves us with $1,000. In the third transaction, bank was again affected, and this time it is increasing by $6,000. So we're going to add that $6,000 to the $1,000 that remained. And this gives us a new figure of $7,000. So $1,000 plus $6,000, $7,000. So that's a new figure for bank. All right, so moving right along to the bank loan. So we go back to the old balance sheet and we pick up the old figure or the original figure for bank loan. Here we have it, $8,000. So this is the figure that we're going to start off with once more. So again, we put the original figures in red. And then now we're going to head to the effects table. So bank loan was not affected in the first transaction, but it is being affected in the second transaction. And we see wherein the bank loan was decreasing by $1,000. So we're going to subtract this $1,000 from the original figure. So $1,000 from $8,000 leaves us with $7,000. So that's the new figure for bank loan. All right, so heading over to the capital section. So again, pick up the old figure for capital. And it is $35,000. And then now we're going to head to the effects table. So capital was being affected in transaction number 3, which would have taken place on March 4. So here capital was increasing by $6,000. So we're going to add this $6,000 to the original capital figure. So 6,000 plus 35,000 gives us $41,000. So the new capital is now $41,000. And then the final item, creditor. So we're just going to check the old balance sheet to see if there was a figure provided for creditor. So no, there was no figure for creditor. So we're just going to head to the effects table and pick up the figure that is there. So in the effects table, we realize that creditor was increasing by $4,000. So that leaves us with $4,000 being the new figure for creditor. So now we are going to prepare the new balance sheet as of 6th of March 2019. And this balance sheet will reflect the items that would have been affected as well as those that were not affected. So when preparing the balance sheet, the first thing that we're supposed to have is a title. And the title should answer the 3 questions. Whose balance sheet is it? What are you preparing? So it's either a statement of financial position or a balance sheet. And it should also answer when. So when are you preparing it? As at the 6th of March 2019. So there we have it. That's our title. So Peter, it's Peter's balance sheet. Statement of financial position as at 6th of March 2019. So it answers the 3 questions: whose, what, when. So the first heading that we're going to have is non-current asset. A non-current asset is the same as the fixed asset. So we're going to rush to the first balance sheet and we're going to pick up all the non-current assets. So there are only 2 non-current assets in this transaction. So we only had equipment and vehicle. And vehicle. And the figure for equipment would be so first it was $22,000, but now it is $29,000. So this is the figure that we will record in the new balance sheet, the $29,000. So no longer the $22,000, but the $29,000. And then we're going to place our second non-current asset, which is vehicle. So this item was not affected in any of the transactions, so we're just gonna bring back that original figure for vehicle. And that is $15,000. So seeing that there were only two non-current assets in this transaction, we're going to total the two non-current assets because we don't have any more. So that takes us to the new title, total non-current asset. So you're going to add $29,000 plus $15,000, and that gives us $44,000. So now that we're finished recording all our non-current assets, we're going to now go to our current assets. So the next heading is current assets. So we're gonna check the old balance sheet to see how many current assets was there. We had two, so we only had cash at bank and cash in hand. And we wouldn't have came across any more current assets while recording these transactions. So considering that we only have cash at bank and cash in hand, cash at bank will be recorded first as it is more permanent than cash in hand. So again, we have two figures for cash at bank. So we had an old one in the old balance sheet, which was $5,000. And after the effects, we would have calculated a new figure for bank. And the new figure is the one that we're going to use. So we're going to use the $7,000. And then now we're going to record our cash in hand. And cash in hand was not affected in any of the transactions, so the figure would remain the same as in the old balance sheet. So that's $1,000. So seeing that we only had two current assets, we're going to total our current assets. So $7,000 plus $1,000 gives us $8,000. I will put that $8,000 right here in the middle column. Right, so in the vertical format balance sheet, we are supposed to show the working capital. So how do we calculate working capital again? That is current assets minus current liability gives us our working capital. So that takes us to our next heading, which would be less current liabilities. So we're going to check the old balance sheet to see if we had any current liabilities there. So no, the only liability we had there was the bank loan, which is repayable in 1 year. So this is a long-term or a non-current liability. But in the effects table, we would have come across a current liability, and that is creditor. So we're going to pick up this creditor figure right here, and we're going to put it in our new balance sheet. So creditor, $4,000. So the total current asset, that is the $8,000 right here, $8,000 minus current liability of $4,000 gives us our working capital. So 8,000 minus 4,000 leaves us with $4,000. So this $4,000 would be our working capital. So now we're going to add our $4,000, which represents working capital, to our total non-current assets. So that's the $44,000 plus the $4,000 gives us $48,000. So seeing that we had a non-current liability in the question, we're going to record it next. So that takes us to our next heading, less non-current liabilities. And that is the bank loan, which was repayable in 1 year. So if no non-current liability was provided in the question, we would just draw our double line at the $48,000 and continue with our owner's equity. So if you don't see a non-current liability provided in the question, don't stress yourself trying to find one. Just move right along to the owner's equity. But seeing that in this question a non-current liability was provided, so we're going to include it right here. So that's the bank loan. So originally, the figure was $8,000 for bank loan. $8,000 was the original figure for bank loan, but a transaction would have taken place which would have affected this figure. So the new figure for bank loan is $7,000. So this will be taken to our new balance sheet. So $7,000 from $48,000 leaves us with $41,000. And then we're going to double line this figure. So we draw our double line on the $41,000. So now we're going to move to our owner's equity. So that's the new heading. So owner's equity. And capital would be recorded right here. And the capital figure would be so originally it was $35,000. But the figure would have changed as a result of a transaction which would have taken place on March 4. So the capital figure is now $41,000. So $41,000. And you would have seen clearly that the totals, they still agree. So we're just going to draw our double line. So the totals, they still agree. So we would have recorded all our transactions correctly in the effects table, and we would have done our working out properly. So if it is that your balance sheet is not balancing, then that simply means that a mistake must have been made. So either in the effects table or when doing the working outs. So that's it for today's video. If you have any question, you can feel free to leave it in the comment section below. And do remember to subscribe to Miss Edipreneur's Corner. Thank you for watching.